Hello and good evening, everybody. Hi, Jake.
Hi, Benny. Hi, good evening, everyone.
All right. If you guys can hear us, can you just say yes on the comment section so that we can start? Yeah. Yeah, we're just waiting for someone to say yes so that they're able to hear us. Good evening, and thank you for joining us tonight. Okay, looks like we're all set to go. Thank you, Darren. All right. Yeah, once again, thank you for joining us tonight. Tonight's topic on what's hot in Singapore. We have Jake Chow with us. He's the portfolio manager with the uh, discretionary portfolio management with CGS-CIMB Wealth. Congratulations, Jake, on your new position.
Thank you, Benny. Thank you. Yep.
Right.
Very happy to switch department and manage to snag this role.
All right. New role for you, new opportunities, eh?
That's right. Oops,
Okay, great.
sorry.
So we actually had Jake on our show before. So today is also going to share with us what are the current trends and what are the factors that are affecting the Singapore market right now. And he will also share with us his model on finding opportunities in the Singapore market. So it's going to be quite interesting because you're actually learning from a fund manager. And based on his experience, he has come up with a model which is going to share with you guys. All right. And if you guys have any questions at all, just type it in. I can bring those questions up to Jake. All right. So Jake, over to you. I believe you have a presentation for us. You guys can ask any questions, and if we still have we still have time after his presentation, we can answer those questions. All right. But if those questions need to be urgently answered in this presentation, then I think Jake is okay to
Please stop me.
interrupt
Yeah,
you in your presentation. Yeah.
that's right. Yeah, please stop me.
All
Yep.
right. Great. So Jake, yeah, over to you, Jake.
Thanks, Benny. And good evening to everyone who's tuning in tonight to listen to what I have to say tonight. And of course, if you have any questions throughout the webinar and you don't feel like bringing it up, please write it down so that you remember to ask them, or you can actually email to me later on. If you are the shy type of audience, yeah, I can always email me and drop me a call. My office line is forwarded to my mobile, so there's no way you can't get me. Yeah. Okay. So yeah, that's right. We are so contactable nowadays. Yep. Okay, great. So let's not waste any time. We will start tonight's session with this. Okay, I will not go too much to elaborate about what I do, since Benny already introduced me, and we will skip to this just to introduce everyone a little bit about our private wealth unit, because as you as we all know, we are known in Singapore, Malaysia, and regional countries as a broker, but as the time evolved, we are moving into the private wealth realm to service and to lend our expertise in managing investments for unique individuals or for anyone with special needs. And of course, this is a dedicated unit to go through your investment journey, and we hope to leverage our experience to grow your wealth and see through the whole entire journey with our clients. And when it comes to products, we have a very strong investment committee, which are based in Singapore and Malaysia. And of course, we are backed by our award-winning research team. And along the way, we have also built our own asset allocation models, plenty of models that we've built along the way from many years of researching and testing. And our product suite includes equities, fixed income, derivatives, mutual funds, and structured products. So these few areas are well enough to cover everyone to look at long-term wealth building, and especially for special tailored mandates, we can always refer to the discretionary portfolio management unit for customized solutions. And before we start tonight, this is one of the things that we have to go through, like it or not. So um, this disclaimer basically says the presentation tonight is meant for educational purpose and should not be copied, distributed without our consent. Um, but of course, this is what the company says. I'm very happy to share what I've prepared tonight because yeah, although it's from our proprietary models, but we are very happy to share with people because the models will not erode away the alpha that easily. Okay, so all this information presented here are we believe to be accurate as we prepare the materials, and whatever I say tonight, it's from my personal views and experience. So attendees should exercise your independent assessment before you make any investment decisions. And of course, investors should not treat this content as a recommendation to buy or sell any securities, and CGS-CIMB will not be held responsible for any potential losses. Okay, so we're done with this. Okay, so what is driving a Singapore market over the last 12 months? Let's take a look. Um, and of course, this is the very basic foundation that you talk to me because I always look at the markets from a very quantitative angle or through this lens that I'm trying to quantify what is actually driving the markets. These are the very basic elements that whether professionals or even non-professionals, they are experiencing their portfolio returns with or without knowing that these are the key fundamental drivers that contribute to their performance. Essentially, a factor is basically just a characteristics that helps to explain the long-term risk-return relationship and performance of an asset, right? So generally speaking, when the markets are feeling bullish, you will find that momentum is very strong, right? You have a lot of rising stocks, small companies are doing very well, and companies that are relatively cheap, right? Inexpensive stocks tends to be on the run, right? So this usually indicates that the market is feeling bullish. Investors are willing to embrace risk. When the investors are feeling a bit more bearish, they tend to look at, hey, is this investment going to yield me something like cash flows in terms of dividends, right? They will look at dividends being paid out. They will tend to focus their attention on lower risk stocks, stocks that are typically very less risky. That means your healthcare, your utility stocks, right? And of course, last but not least, quality, right? Quality basically means the quality or the soundness of your balance sheet. Every company, or rather behind every company, there's a business, right? So when you zoom into the business, you look at how sound is this company, right? So that's the G's of the quality factor. And so let's look at what's driving our markets over the last 12 months. Over here, you can see this is basically in a table format. This upper half of this table that you see over here, you will find that this first line over here, it says FTSE Singapore Real Estate. It basically says REIS. It's the developer index that captures or monitors the property developer in Singapore. So you can see that over the last 12 months, it has 44% returns over the Singapore STI index. And that is to say, this sector itself is experiencing a very strong move, and this is what we call momentum, right? So this particular index that you see over here is also very consistently strong over the last 3 years. You see that average returns is about 8.16%, average over 3 years. So this is one of the key things I typically look at, whether the short term tallies with the longer term. And this second line over here is basically our STI index. You'll find that our index is positive 31% over the last 12 months. And this is mainly driven by the heavy weightage in our local banks. So when you look at banks, it's typically telling you the value factor is in play because banks are typically more um, in usually categorized or in the basket of the value factor because it's generally cheaper in terms of valuations and it tends to pay out more dividends and the balance sheet is quite sound. So, but that's not the only industry. Typically, some industries, some companies in the industry sector is also uh, bucket into the value factor as well, right? But usually, when we look at the banks are running, the financials are running, it typically means value is moving. And of course, this um, second role that I've stuck out over here, it's the China index, right? This China index is basically some of the common household names that we are very used to who derive a lot of income from China. Uh, Not necessarily they are Chinese companies, but companies that heavily rely on Chinese for any revenue or earnings growth. So you can see that these two are very consistent over the longer term and the shorter term, but of course it's lagging behind the index. Yeah. So, oops, sorry. Okay. And the third one to focus on that I've secret out is basically the REITs sector index. Rather the REITs index. You can see over here it's positive 10% and positive 9.7% over a 3-year period, right? So it's also essentially telling us that right now it's in line with the longer term um, historical performance, but it's lagging behind. So it's one of those areas that I try to sniff out and see whether these sectors are running. And if they're not running, actually, they are more ideal for investors to pay attention to. If they are running, then of course, traders can also look at the REITs sector as well, or the segment as well, because more often than not, long-term returns in Singapore, especially in Singapore, it's heavily dependent on the REIT sector or the segment because it's the key driver and its average returns of 9%, it's quite extendable into the longer term. That means it's one of the key contributing segment in Singapore market. And as we all know, Asians tend to focus on a lot of investments on the property sector as well. So therefore, you look at the property sector index, it's also very strong and it's very consistent with the theme that Asians love investing in properties, and therefore this market is generally quite stable and contributes a lot to the outperformance of our broader index. Yeah. So this is basically a visual replication of what you've seen earlier in the upper half of the chart. Right. I'll go back to refer to the table later on. Right. So I've actually highlighted and bold the lines that I've mentioned earlier. This particular green line over here, it's the REITs sector index. Right. So visually, it's not hard to tell that over a 3-year period, when we look at all the broad market indices, the REITs, it's easily one of the more consistent and persistent outperformer. And of course, you can see this blue line that it's not that consistent, but it was outperforming more recently, right? You can see there's a bit of underperformance against REITs and against this red line, which is the line for the property index, right? So you can. It's not hard to see that visually these three sector, these three broad market indices, it's the stronger performer in our market. And going back to here, um, continuing this part, these are the sector indices that the FTSE has came up with. In fact, they make some changes recently. I'm still trying to get used to some of the indices over here. So what I've done is basically I've figured out um, the very consistent outperformance within the market and tally them with the short-term performance as well. So on top of the list is it's healthcare, right? So healthcare, it's a top performer in terms of sector. It did about 59, 60% in terms of price change, total returns of 63%. So this sector is leading the charge right now. Of course, it will soften a bit, from time to time we'll go into correction. But nonetheless, these are the key things that traders should pay attention to as part of the process to try to screen and read the market. They need to know from top down what's going on with the market so that it's easier to zoom in and find the right names for whether it's for trading or for investing. So the second over here is the tech index, right? So it's quite consistent over a 3-year period as well. You can see it's actually the top performer in terms of outperforming the rest of the sector indices. So a 23% 3-year annualized returns is quite strong, right? If you ask me. And of course, the other sector that I would like to highlight is the consumer staples index. You can see that over a 3-year period, it's quite consistent at 8.19%. And even though right now it's just shy of 20% over the last 12 months, but it's still fairly good, right? It's considered a lagger, but I think these are some of the areas that traders or investors should pay attention to, right? So going back to a more visualized way of looking at data, bearing in mind what you see in the table is translated into this chart visually. So sometimes, like they say, picture speaks 1,000 words. So it's very obvious to a lot of people, even to the untrained eyes. I don't think it's very difficult to see that this purple line over here is actually the tech index. It is very strong consistently over a 3-year horizon. And bearing in mind, the tech sector, it's one of the key sector that tends to outperform over a longer term as well in most of the markets worldwide, whether it's Hong Kong, whether it's Japan, whether it's US, they tend to be the outperformer. Of course, there will be rotational period, but over time, always pay attention to the tech sector. And this yellow line over here is the consumer staples, and this white line over here is the healthcare sector, right? So you can see the healthcare sector is not as consistent compared to the tech sector, whereas the consumer staples are very, very consistent over this period. Even through crises like COVID, it tends to bounce back relatively strong. And for the rest of the sector indices, you can see over here, it's very lethargic. Some of them, like your basic materials in gray over here, right? It tends to be or rather it's underperformer throughout this whole entire 3 years we've been observing. And you can see this green line over here, this energy, right? It's not very strong as well. And this aqua line over here for consumer discretionary. So with or without any headline news or with any macro changes, you'll find that these are the ones that you want to stay away from, or at least not pay too much attention to them. But of course, if you're a trader and you do all this screening on a regular basis, you tend to notice the change, right? So it's part and parcel of our toolkit that we do a lot of regular screening to find out where we should zoom in. But of course, without doing all this, we can actually also zoom into the markets by having a different type of model, and that is the dual momentum model. I've created this to help both traders and investors to have an easier time to screen for ideas, whether it's for short to medium term trading or even for the longer term investors. Should they be looking at some of the names in the portfolio that are running? Should they be trimming their positions? Should they be loading up more? Should they be getting out of some positions? Because this model doesn't just look at the market as a whole. It actually splits the market into two. I'll touch a little bit more on that later. So traditional research usually focus on cross-sectional momentum, which we call the relative momentum. And this is usually what traders are very used to, right? But of course, the drawdown of just relying on relative momentum tends to face a steeper drawdown when things go wrong or when markets go into a very deep correction. So to mitigate this problem, we actually apply absolute momentum, and that's the reason why I call this dual momentum, right? So by applying this absolute momentum, it can actually help to control and reduce the downside risk significantly. And and to incorporate these two together, we use a two-step process, right? So the first step process is to screen for um, the absolute momentum first. That means names that don't qualify or they don't meet our criteria will be screened out, right? But of course, before we even do that, we have to decide where is the universe, which country, is it sector centric, or is the universe from a particular index, or is it going to be industry centric type of screening, right? In this case, what we're doing here is basically focus in Singapore. So we decided to screen the Singapore market, but of course, this model can screen the world. It depends on how you adjust for the criteria. So what I've done is I've created different models for different countries and different markets because they tend to have some idiosyncratic risks if we just blindly apply the model on all the markets. Yeah, but just to focus on topic for tonight, we just focus on Singapore. So we have also put in a lot of things to control for the tradability, so that we can screen out names that are too small, too illiquid, so that we can really spend the focus on names that are deserving of our attention, right? So some of these things like um, sorry, yeah, some of these things like the rules that we built in place, like whether the last price is above or below the 200 days moving average. So this forms part of our absolute momentum criteria, right? I won't bore you with the technical details of how we built this model, but after this model screens out the universe that don't qualify for the absolute momentum, or sorry, those that qualify for the momentum, we will pass the remaining names or the universe into the statistical scoring model, which will then score for the relative momentum within the universe, right? So based on the 5 criteria that you see over here, um, yeah, that this forms the backbone of a model, and after that, the results will come out from the model, and we will normalize these statistical numbers, right? We call them Z-score, right? So to make it more readable, we normalize them so that it reads from 0 to 100, right? So after this, we'll rank the scores. Sorry, we'll rank the names according to the scores and put them into 4 different buckets to identify um, whether they are the strongest one or the not so strong ones. Yeah, so you will see later on in the next slide that what we've done after passing through the model, right? So in the positive model, what we see in the first quartile to be names to be containing names that are the strongest within the universe, right? So the second quartile will be relatively strong, and the third quartile will be fairly strong, and the fourth quartile are the names that are either names that had a great move and they are in the midst of a pullback or a correction. They're still technically positive, right? So this is one part of the model. The second part of the model is the negative part, right? So we actually also include the negative momentum because we don't want to waste time to look at names that are very weak, that are not going to perform well in the next 3 to 6 months. We don't want to waste time on that. But that part of the model can also serve as idea generation for traders who either want to take advantage of the negative momentum to go short on these names, or either for longer term investors to look at, hey, why are my names in the negative model, right? Are they weak for fundamental reasons? Sometimes it could be, right? A lot of times when the stock goes into a major decline or it goes into or got caught in a spiral, uh, usually also linked to earnings and their revenue, right? So this serve as a different screen uh, for traders to look at, but most of the time traders only look at the positive model and tend to pay lesser attention to the negative model. And I would like to give you a snapshot of how it looks like. Um, Basically, this is downloaded data of uh, rather the data I exported out from the model for sharing with my clients and our brokers internally, right? So what you see is the first bucket over here, right? So these are the names in the first bucket, second bucket, third bucket, and the fourth bucket, right? Here along it comes with the scoring, right? So of course the higher score means you're very strong in the positive model. The lower score means you're not that strong. And I've also color coded the price change to indicate how strong how strong these names are in the respective different time frames. Yeah, so visually you can see very easily that these are the names that are very strong. Uh, these are the names that have a little bit of pullback or correction. These are some of the names that are very likely in the midst of a pullback or correction. And these are the names that are going through a correction, right? But still positive over a 12-month period. So the trend may or may not end as of now, but of course, if it ends, the model will kick them out, and you don't want to waste time on names that are not going to give you a good return. Right. So moving on to sharing or to deep dive. Okay, I want to use the word deep dive to highlight some of the names within that spreadsheet that we saw. Oh, sorry. Can I just go back here? I forgot to show you the negative model. Right. So on the negative side of the model, you have names that are not doing well for now. Names like UJ Healthcare and let's say some names that were some familiar with, like Top Glove. Yes, right. Top Glove is a Malaysian company that's listed in both Malaysia and Singapore, right? So these are some of the names that traders should avoid for now, and perhaps names that in longer term investors can pay attention to when it starts moving out, moving down the list and move back into the positive momentum, or when it comes to around the third or the fourth quartile of the negative model, right? To indicate that the selling pressure has eased off, right? Otherwise, it's going to be very painful for any investors to take a position when it's still in the midst of a decline. Right. So moving back to the first name that I'm going to talk a little bit more about in this positive um, model, it's Chow Energy Resources. Right. So Chow Energy Resources is a coal mining company. It owns and operates coal mines in Indonesia, and of course, a big bulk of its revenue comes from China and Indonesia. A bigger bulk is from China, so it's very China sensitive. And I believe most of us are very aware that the global energy high prices, or rather the surge in energy prices and the shortage in China, it's forcing them to load up on coal from overseas imports. Right, so this is one of the key catalysts that Chow Energy is running. Right, so Chow Energy currently has a market cap of a little bit below $500 million, standing at $487 million. And over the last 12 months, it has returned about 247%. And in terms of profitability, it actually has experienced a revenue growth of 23%, and its earnings growth data is not reported right now, but its earnings or rather its profitability ratios are relatively favorable at 30, ROE at 34.5%. So these are some of the key things that traders or even fund managers look at when they decide, hey, is there a key reason why we're going to own this stock, or any reason why we're going to take a even a speculative position in these positions, by also making sure that there are some good fundamental reason to onboard some of these names. And you can see that the debt ratio for this company is not too high as well. It's currently 27%. So some of the conditions are very favorable, and therefore you see quite a fair bit of institutional interest in certain names, right? And of course, the valuations are also quite compelling for traders or investors to take a position in this name, right? So it's currently trading at 4.7 times to its trailing 12 times earnings, and its forward earnings is about 3 times, right? So these are some of the fundamental reasons to own a stock as well, not just trading them, but to own them, right? And of course, in the space of dividend yield, it's not really high. It's currently at 1.45%, right? So the key catalyst of this Joe Energy is mainly driven by the shortage in um, energy energy supply in China. So definitely something to look at and to pay attention to. And of course, this second name that I'm sharing with everyone right now is called PropNex. So PropNex is, I'm not sure whether you guys are familiar with PropNex, but PropNex is a very household name in Singapore because it's a property agency, right? It currently has quite a fair bit of presence in Singapore, Indonesia, and Malaysia, right? But of course, if most of us are not into property investing, we may not hear of this company. PropNex currently has a market cap of 700 million, 700 odd million, and over the last 12 months, actually returned 233%, right? So you can see on this chart, it experienced a strong move over the last 12 months. Of course, a lot of you would definitely ask, can this last? Well, nobody knows, right? But nonetheless, there is a lot of fundamental reason why the stock moved. One of the key reasons is because the fundamental numbers are playing catch up to to the technical move, because we have seen profitability improve for PropNex, because the revenue growth actually turned around, reversed. It registered a 22.8% in terms of revenue growth, and 45% EPS growth over the last 12 months, right? Its earning ratios are also very good. Its ROE is currently at 51.5%, and its debt to equity is 3.8%. So both technically and fundamental guys would say, hey, look, this is a good combination um, for everyone to, take a punt, or even take a longer term positions, right? So its valuations are not really that cheap, but nonetheless, it's still in the mid-teens of 15.7 times to its 12 months earnings, and its forward earnings is 12.2 times forward earnings. And in terms of price to sales, is about 1 time. So when you look at all this fundamental reason, there's definitely a key catalyst why this PropNex is experiencing a surge, right? And not forgetting the fact that this could also serve as a good fundamental name to fundamental investors, because it's currently paying at 4.9% dividend yield, or rather indicative dividend yield. So this could be some names that will interest both short-term traders, short to medium-term traders, or in fact the longer-term investors, right? Of course, the main catalyst behind this, like I said earlier, is a change in the fundamentals, right? So they managed to stand its 4 consecutive quarterly decline in its earnings, and they've started to turn things around over the last 2 quarters. And on top of that, COVID is also additional tailwind to its move because more and more people are working from home, their housing demand has been uh, silently or gradually changing as some people are swapping their properties for larger properties. And of course, that because of COVID, the changes in the rental market has gradually been reshaping as well over the last 4 quarters. Right. So this second name, it's also um, it's also in line with the third name that I'm going to deep dive a little bit about. So APAC Realty, it's also another agency. I'm sure a lot of you have heard of ERA, right? So ERA is, I would say ERA, it's a more well-established property agency in the APAC region. In fact, they have presence in 17 countries and they have more than 600 offices in the APAC region, right? So they have close to 20,000 of sales force in the region. So in fact, I'm more familiar with ERA than with PropNex. But PropNex have done really a great job catching up with ERA. And these two agencies that I'm looking at, they are, of course, listed and they have gone through their fair share of challenges when it first got listed. So, but of course, ERA is smaller in size in terms of market cap, right? It's currently at trading at 287 billion uh, market cap, and over the last 12 months have returned 156% in terms of total returns, right? So um, the property sector is definitely behind one of the key drivers in pushing the Singapore market higher, right? So and therefore these are some of the names that prop up in our screening model. Okay, in terms of profitability, um, ERA has experienced a 6.8% revenue growth and 17.3% earnings growth over the last 12 months. You can see it's a little bit trailing behind PropNex. In terms of profitability, its ROE is currently at 16.1%, and its debt to equity is 35.8%. Right. So looking at the fundamentals, there is a little bit of a gap between the two, and that is also partially one of the reasons why it didn't move as explosive as PropNex. Right. In terms of valuations, I would say it's currently very attractive at 11.46 times to its trailing earnings, and its forward earnings it's 10.38 times. So it's trading at 10 times to its forward earnings. Definitely a very attractive proposition to investors as well, not just traders, right? So the fundamentals look fantastic, and it's also having a very high indicative dividend of 6.33%. So both the fundamentals and technicals are favorable to some of these names. Guys, keep a lookout and um, put them on your watch list, right? Don't forget that um, sometimes trend will last more than longer than you expect, right? Of course, bearing in mind um, the APAC Realty has also gone through the same thing as PropNex because it actually started to reverse from its EPS decline over the last 4 consecutive quarters, and they have managed to turn things around. And therefore, if you look at the longer term chart, it wasn't doing very well right after they got listed, sorry. And right now it's a turnaround thing. And of course, the property agency business is also experiencing a tailwind from how COVID has reshaped the property market or the property segment in Singapore. And sorry, not just in Singapore, but the APAC region as well. Right, moving into the third stock, fourth stock. Fourth name is UOB Bank. Of course, in the model, you find that most of the banks are, or rather, the three banks are in the positive model. But why I choose to highlight UOB is simply because it's in the middle of the three banks. Um, I'm sure a lot of you are very familiar with UOB Bank, right? So this is a big cap name, and over the last 12 months, it has a 49% return so far, right? In terms of total returns, right? So one of the key things is because banks are typically very big and they're not that mobile in that sense. So you don't expect banks to move like 100, 200%, right? The 49% move it's quite significant, right? And of course, I'm picking this name because technically it's showing me some signs of testing the resistance, whereas DBS already broke through the resistance. So I'm trying to anticipate whether this UOB can break through, right? So that's one of the key reasons why I'm highlighting this name instead of DBS, or in fact OCBC. OCBC is a little bit lagging. It's a little bit weaker in terms of the technical movement, but nonetheless, most of them have very similar fundamental and changes in earnings over the last few months, right? So, but in terms of valuation, it's also not very not very uh, at high valuation levels because there's still a little bit more room compared to DBS, and that's the reason. That's also the additional reason why I choose to look at UOB instead of DBS because DBS is currently trading at 1.42 times to book, and UOB is currently trading at 1.16 times to book. And PE is about 13.9 times forward. PE is about 11.7 times. So based on this fundamental matrix, we should expect UOB to have a little bit more upside compared to DBS, right? Of course, in terms of dividend payout or dividend that investors are expecting to get is about 3.6%, right? So that's definitely more attractive compared to DBS right now. And of course, the key catalysts to the strong performance in the banks are mainly the broader market, the broader markets expecting a rising interest rates environment going forward, right? That's not just what the Fed is likely to do. In fact, that investors worldwide are shifting their portfolio to anticipate a higher interest rates environment, and therefore the banks will. It's naturally part of the ecosystem that will benefit from a higher interest rates regime going forward. Correct. So the fifth name that we'll share with everyone is UMS Holdings. As you can see, the score over here it's 40.46. Right. Do not take it with too much of pinch of salt because these numbers will change when it goes through a correction. You will see that the numbers get softer a bit, and if it doesn't break down in terms of its technical trend or its momentum, you will see that the momentum starts to pick up again after it went through a correction, and you will see the numbers go up. Right. So UMS holding currently uh, it's quite caught in between. It's not exactly a mid cap or a big cap. Right. I would consider it's a mid cap because it's currently its current market cap is $880 billion, right? So it's a little bit shy of that 1B mental threshold, right? And so but then again, this name perhaps has the potential to reach the 1B market cap mark because it has been quite consistent in its revenue growth and earnings, right? And you can see that rather this UMS has actually returned about 80% over the last 12 months. It's much stronger compared to UOB, right? Like I said, because it's too big. So companies that are too big in terms of market cap, they don't tend to move that much, right? So this is the size factor that I've talked about earlier because a smaller cap name has more potential to have larger gains. So in terms of profitability, the revenue growth for UMS Holdings, we see the trailing 12 months is 24.7%, and its EPS has grown by 9.1%. Right. In terms of ROE is quite fairly strong as well at 17.3%, and it has got very low gearing. Its debt to earnings is 8%, right? So when it comes to valuations, UMS being in the tech sector is not really cheap nor expensive. It's currently trading at 18.9 times trailing earnings, and the forward earnings is currently at 14.19 times. Uh, in terms of in terms of dividend yield, it's not very attractive. It's only paying about 2.12% in terms of yield. But of course, if the company can continue its consistent performance, I guess the dividend may grow down the road. Right. So one of the key catalysts for UMS strong performance is mainly due to the global shortage in chips. Right. So as we all know, the global shortage in chips is not likely going to go away anytime soon because you cannot possibly build the kind of capacity uh, overnight. Let's not let's not even say overnight. Over 6 months is it's almost impossible. It's a major challenge to plug the gap in the supply side. So yeah, so on top of the macro environment, UMS has been very consistent. It's maintaining um, its uh, its revenue and its profitability over the last few years. So the technical trend, if you look at the chart, it's been doing fairly well, right? On and off with some correction, right? The sixth stock that we're looking at is AEM. AEM, it's also in the tech sector, right? So it basically designs and develops and manufactures electronic products, life science and sorry, and for aerospace industries. Uh, AM, AM is slightly a little bit larger. It's currently 1.3 billion in terms of market cap, and its last 12 months it returned 29.57%. Right. Of course, from the chart, I don't think you can tell that it didn't really do so well, but you can see it actually went through a correction prior to recovering above the 200 days moving average. So these are very typical signs that when you can recover from a correction, the trend is likely going to persist. Right. So EM actually has also been very consistent with its revenue growth. Right. So over the last 12 months, they have grown their revenue by 60% and their earnings by 82%. Right. Their ROE is currently at 33.2%, and it's also very lowly geared. Its debt to equity is only 5.3%. So these are very good fundamental reasons for both investors, right, to pay attention to. And when it comes to valuation, it is quite attractive as well because for a tech name to be trading at 16.37 times to its trailing earnings and 15.3 times to its forward earnings, I think the valuations are very, very attractive. And not forgetting the fact that most of the tech names actually don't pay high dividends. So if you're a dividend holder, this name only pay 1.22%, right? So it's not actually a very great dividend name for for investors, but it's definitely part of the name for your growth part of your portfolio, right? And yeah, the main catalyst is still the same as what I've mentioned earlier, and of course, very much more. Sorry, the second key driver is also its ability to maintain its profitability, right? So not just the macro environment, but at the firm level, it's able to do very well. It has got a good report card to show investors, and therefore investors are rewarding the stock or the management with its positive stamp of approval by beating up the stock, right? Or by investing in the stock. And the last name that I want to share with everyone is Tianjin Pharmaceutical, right? So this Tianjin basically produces and sells TCM medicine, Western medicine, and health products, right? This is a slightly bigger name. It has uh, it has actually returned about 40.11% of the last 12 months. Right. In terms of revenue and earnings growth, it's actually not that fantastic, but nonetheless, it has very low gearing. So fundamentally, when you look at the balance sheet as overall, it's quite attractive. Its ROE is currently at 14.3%, and its debt to equity is 4.6%. Right. So sometimes you don't have all the stars in alignment, but some of the matrix that people are looking at could be very attractive, and therefore um, the stock will experience some positive momentum because investors and traders alike are pouring into the stock. And in terms of valuations, it's very attractive, currently trading at 6.2 times to its 12 months earning. I don't have data for the forward earnings, but fundamentally, these numbers are very attractive for investors. And it also pays out a relatively high dividend, uh, indicative dividend of 4.38%. So these are some of the things that investors do pay attention to, right? If the growth is not there, we want names that give us the dividend, and this name it matches that criteria, right? Um, okay, so I've come to the end of this particular part of screening for technical ideas. I hope there are no questions on that before I move on to screening for the fundamental or the investment ideas.
All right, thanks, Jake. So, guys, you have
Yeah,
any questions? You can ask those questions right now before Jake proceed to the next presentation.
I also I
Um,
also need to take a break. I need to drink the water, drink a bit of water.
yeah, so to look at it, you're looking at one of the trends that are moving now is basically properties, right? Because
That's
you
right.
have given the two counters, PropNex and also APAC or ERA. You have the bank, you have tech in there, and
Yep,
health as well, which is TCM, right? From
that's right.
Tianjin.
Correct.
Yeah. So
Yep,
these are the ones that are that has actually come up from your screener, right?
that's right. That's right.
All right.
Yep,
I was just wondering, Jake, because
yep.
for quite a long time, the tech sector PE for Singapore, the price earnings ratio of Singapore has been around these kind of levels, right? About 14 to about 20. But of course, you
That's
see,
right.
like even tech companies in Malaysia, you're looking at between 40 to 60 kind of PE, and of course,
Mhm.
US is a different story, lah, right?
Yeah.
Yeah, but why is it so? Why is it that the price is I mean right now is quite attractive as a tech company in Singapore, but why is it has been quite low? Because like if even it's 14 PE, it's more like industrial kind of sector PE in Malaysia, right? So
That's
can you
right. That's
just
right.
can you just let us know why it's most of the time quite low in Singapore?
Okay. One of the key reason is because of the low institutional coverage. Yeah. Because a lot of the institutional investors, they have certain unspoken rule. Like for
Hmm.
example, if let's say I'm a global fund manager, I tend to benchmark against global index. And if the global index that I'm trying to follow has got a 1% allocation to Singapore, right? And usually they will work around those numbers and not try to uh, do the opposite. That means if they are managing $100 million, they will only allocate 1% of that $100 million to Singapore.
Right.
Yeah, and because globally, our allocation exposure in major indices are not very high to begin with, so that is one of the key reasons why more money is not being channeled to Singapore. That's one, and of course, the second thing is the research coverage. The research coverage is also not that well um, covered, if you ask me, compared to elsewhere in the world, like Hong Kong and China. That is
Mm.
fundamentally problematic because you need more research guys to really get in sync with the investors. But of course, with the investors not willing to allocate more due to all these uh, allocation reasons because of the indexation, um, yeah, unless that change, right? Let's say Singapore get a higher weightage in all these major indices, then very likely that more managers will pay attention to the Singapore market. Yeah, so
Right.
that kind of weightage to Singapore is not naturally not high to begin with in the first place, and the the coverage on the sell side is also not that strong, especially given our our market ecosystem. Uh, I, I do have certain uh, ideas that uh, why our market is not that strong, but okay, that's a topic by itself, right? Yeah,
Okay.
it's a whole ecosystem. It's a whole ecosystem. So a lot of things needs to be uh, put together by the regulator and by the exchange. If these elements are not in place, it's very difficult to raise our tech companies beyond a certain level, right? And of course, if let's say there are more investors willing to be more Singapore centric or more Asian centric, then perhaps uh, more money being poured into these names, you will see naturally the P will tend to move up a little bit. And of course, not forgetting the fact that higher P also in theory represents higher growth, right? But of course, this higher growth isn't in sync with what investors are willing to pay. Naturally, when you look at a higher growth company like let's say AEN or UMS for that matter, their growth rates are not that fantastically high if you put them into the industry peers in the region, right? They
Right.
may be strong in Singapore, but when you put them side by side with regional peers, they may uh, just be right in the middle or below the pack. So when you are all fighting for institutional interests, you may, or rather, we may lose out in that sense because you know at the end of the day, whether your stock is going to move, am I going to beat up your, your stock price? Am I willing to pay higher valuation? It all depends on whether the big boys are interested in the names, right? Because let's not forget there are lots of it's like a beauty pageant, right?
Mm,
So whoever
mm,
looks nicer, whether fundamentally or technically, he or she is going to get that vote of confidence by the investors paying to buy the stock. Yeah.
right.
So
Right.
all this comes into play. It's not just because they are in Singapore, but of course, being in Singapore, it's a handicap for them for some obvious reasons, right?
Right.
Um, but bearing in mind, let's not forget if let's say I think there have been talks about Temasek setting up a fund to focus more on Singapore markets, right? But what I read recently is that they are focusing on unlisted names or growth stage companies that are unlisted, but they will bring them to the market for IPOs. If they're able to do something like that for the listed names, maybe perhaps that will change the game as well.
Mm.
Yeah,
Yeah, I guess
but
Singapore has this stigma of being a financial hub rather than also a technological hub, um, and that's why the banks are
that's
performing strongly.
yeah, that's true as well because we only have a few names and we
Mm.
we haven't built an ecosystem to attract more technology firms to be based here and to get themselves listed here. If that kind of trend does take root, that may be a game changer for us.
Right.
Yeah.
Okay, we have a question here from KF Chong, and anyway, thanks
Uh,
Jake for the answer.
mhm.
He's KF Chong is asking, is there? I know. I mean, DBS Bank is basically like the godfather of banks over there in Singapore, and then we have banks
Yep.
like UOB and also OCBC. Because you mentioned that OCBC is quite lagging behind these two banks. So KF Chong
Yep.
is asking, is there any particular reason why it is lagging?
Uh, that's a very good question. Um, when I examine the balance sheet of the three banks, they look almost the same with some
Mm.
slight advantage on DBS. Yeah. If you go into the more quantitative side of things, DBS does have advantage. It does stand out a little bit. And that's also one of the reasons why it is usually the first to move, and the rest of the two will do catching up, typically
Mm.
so. Yeah. Um, in terms of profitability, they're about the same, right? OCBC is slightly a bit disadvantaged, but the difference is actually not very huge. Yeah, it's a matter of focus, right? Usually people will go for the name they're the most comfortable with, or the name that catching all the right headlines, because DBS is always the pioneer in terms of being the regional digital bank. So their IT infrastructure is definitely the best amongst the three. Yeah, if you ask me, I'm a local guy. I can tell you, I am very happy doing banking with DBS.
Mm.
Uh, yeah, because I've experienced. I mean, I've got accounts with DBS and UOB. Um, when I go through the kind of user experience in using their technology infrastructure on the consumer side, DBS is the leader, right? They are always very nimble and very fast to embrace and implement technological changes to their platform, right? So that's the reason why they won the digital bank, right? UOB, it's a bit slower to catch up in terms of technology, right?
Mm.
Yeah, the technology adoption is a bit slower, and so is OCBC. I believe investors are forward looking, and basically they are doing the evaluation and say, look, amongst the three guys, their numbers are looking very, very similar, but in terms of that advantage or the edge that they have would be the first mover advantage in terms of being first to the market and changing how banking landscape could be, right? So amongst the three banks, DBS is definitely the stronger ones out there, influencing how people bank. Yeah, right.
Right.
So yeah, I'm sorry to say I may invest in OCBC, but I don't have an OCBC account for personal reasons.
Really?
Yes,
Okay.
yeah.
Okay.
But I'm doing most of my banking with DBS because I love to use the internet banking. Yeah,
Yeah.
it's a
I guess
nightmare
every
using you.
yeah. I guess every Singaporean would have a DBS account, right?
That's right. Yeah, that's right. But they're also doing all the right things, you see. Yeah. So
Mm.
as a company, if you are doing all the right things, you are being the leader in your field. Naturally, you will get investors' attention, and they will reward you by investing in your stock, and therefore your price will move up, and your valuations will tend to be a little bit more rich in that sense. Correct. If you're looking at valuations right now, DBS is the slightly bit more. Uh, I wouldn't say overvalued, but a little bit. They're the more expensive among the three. Yeah.
Yeah.
So technically speaking, you may have that little bit of upside move, but naturally people tends to rotate. Yeah, even investors they tend to rotate. At some point, if let's say my DBS holdings has reached a certain percentage, I will need to trim. Yeah. So by virtue of trimming, it tends to cap the upside from time to time, and you see that rotation move into a different name within their peer segment or industry, and you will get that kind of rotational switch. Yeah,
Okay.
because they will tend to switch to a cheaper name within the same segment.
Mm. Mm. Okay, thank you. Thank you, Kev Chong, for the question. And question here from Casey Chia. Yeah, under your screener liquidity, what is 3 months ADV?
Okay, ADV basically means average daily traded value. It's not volume, right? We typically like to use value more because value it's price times volume, right? It's sometimes not a good idea to just look at volume because volume could be very misleading if, let's say, you're looking at a micro cap that trades 50 million or 15 billion a day. So that's not a good representation for a metric or a parameter that we use for screening liquidity, and therefore we uses uh, average average daily value instead of
Value.
volume. That's right. Yeah,
Okay. Okay.
because yeah,
All right. So before we move on further, I just have one more question for
yeah.
you as well, Jake. talking about the
Yep.
property sector, it seems to be right now. I mean, you look at PropNex and APAC. The property sector seems to be moving in a trend. But I
Yep.
remember you also mentioned that most analysts or maybe the market is expecting raising interest rates. Do you think it will put some brakes on the property sector?
Naturally, because I think yesterday or the day before, or maybe just recently, I can't remember the exact timing. Singapore government is going to roll out more cooling measures
Mm,
to, yeah, basically to reduce the kind of speculative money flowing within the system. Yeah, naturally, yes, that would be a headwind for property developers and even agencies as well. Yeah,
right.
of course, if let's say the valuations are still okay, it gives you a decent return in terms of dividend yield, there's definitely more upside. You may go through a correction. Yeah, correct. Sometimes headline news will tend to make investors realize, are we pushing the valuations or the prices a little bit too far ahead of themselves? They may take a
Mm,
breather, but if the correction are reasonable, I would say it's a good opportunity to pick them up. Yeah,
right.
especially the fundamentals are fairly alright.
Okay. Thank you. Okay. There's no more questions from the audience. You can continue.
Okay, yeah, the investment side is a little bit shorter, so I hope to finish it in about 10 minutes. Yeah, okay,
Right.
let's carry on. Okay, so I'm a very model guy, so I like to build models. Essentially, models are just systematic process or a way of defining how we should approach our investment strategy. In this case, I built a model, and in fact, this model was actually shared last year when I uh, came online with you guys in August. Yeah, essentially, this is the same model. I just make a few refinements over the last year or so, yeah, just to make it work a little bit better, right? So essentially, we start off with a rule of saying, hey, I want to invest in Singapore market, uh, common stocks, including REITs, above a market cap of 250 million. And from there, we put in certain rules that says, hey, I don't want to invest in stocks or allocate my money to companies that are very richly valued, say in terms of like 40, 50 times P. Yeah, I don't want any of that. So what we do is we use P in this case. You can use um, generally anything. You can use a combination, a composite metric. That means you use PE, price to sales, price to book, um, if you see fit. Because if you are investing in a specific sector or industry, you may want to pay attention to certain metrics not appropriate for that sector or industry, right? So I'm using a general matrix such as P because it tends to work very well. One of the better metric around, if you ask me. Of course, it's not appropriate in some circumstances, like for example, in fact, it's not good for REIT. It's not a good valuation metric for REIT, but nonetheless, I'm using it because I have other things in place. And after back testing, I realized that I, even by including REIT, I think it's fine. But if I want to be more specific, I can actually remove the REIT from the universe to be very, very stringent about it. Yeah, but since it worked, might as well because I just need a generic model. Yeah. So in this case, I also look at things like ROE, operating margin, right, and the earnings growth. Not forgetting because usually what works is you look at the top line and the bottom line. Top line
Mm,
meaning your revenue growth and your earnings growth. Right. So we incorporate the matrix into the selection criteria, and of course momentum. Uh, in this particular model, I tend to be a bit more strict because I want names that are giving proven themselves over the last 5 years. That means I put 5 years past momentum. Right? So naturally, this model will exclude newly IPO names. Right? So, but
mm.
that's my intention. So I'm not too concerned about newly IPO names in this case, right? So I've decided to put in all this stuff like 3 year, 9 month uh, total return matrix into the model. And for liquidity, I think I put in just to make sure that it's tradable up to a certain scale. I have half a million threshold for ADV over the last 3 months, and also to make sure that I'm avoiding names that are very tightly held. I make sure that they have definitely more than 15% free float in terms of market cap. Right. So when we put all these rules in place, you can uh, you can put it. I'm sorry. You can put them together. If you're technically savvy, you can actually code them. If you're not, you can just simply write them down and say these are the rules that I will follow. If it doesn't hold, I would not look at these names. In fact, nowadays there are a lot of trading platform or software that allows you to do very, very, uh, very good screening without knowing how to code, right? So with this, you basically um, go on to the next stage of the portfolio construction by deciding, okay, what do you want to do with the remaining universe that pass through the screen, right? So if let's say your model passes out 100 names, are you going to invest in 100 names? Yes and no. If let's say you're running, uh, a big amount of money, let's say $100 million or $1 billion, yes, why not? Right. So looking at the capacity um, and the circumstances, we decide. Okay, look, we are looking at sorry, we're looking at an investment portfolio that easily accessible to most people. So 25 names, 25 to 30 names, it's an ideal number because it provides you with the right diversification. Naturally, you can go beyond. Let's say you can go beyond 50 names if you want, right? But it's harder to implement, harder to manage if you're not doing this professionally. Um, in fact, for a lot of retail investors, I think you can do 15 names to 20 names, not difficult, especially if you have a very keen interest to manage your own portfolio, right? So what I do is I decide the numbers to cut off. In this case, the rule to cut off as well, I've decided to cut off at 25 names that pays me the highest dividend amongst the remaining universe. And the next stage is deciding how do you want to weight these names, right? You can do equal weight. That's the simplest and easier to manage. Or you can do factor weighting. That means the one with the higher yield, you allocate more. The one with the lower yield, you allocate less, right? So you write down specific rules how you want to do your portfolio weighting, and after that you rebalance. You choose how frequent you want to rebalance. In this case, I said rebalance once every 6 months, so that I don't have high turnover. It's something easier for even for a professional manager to manage because you don't want to keep doing this, and yeah, waste a lot of transaction cost along the way. And the best part is sometimes by rebalancing more, you don't actually improve your performance, right? So sometimes less is more. Yeah. So once you set up the rules, how you want to engage your portfolio investment, um, then you set out to implement them, right? So this chart over here is basically a back test of what you would have achieved if you implement this portfolio strategy, right? So this one is to validate whether this strategy works, right? So we put it through a back test, and of course, before we launch products, we will back test until you cannot back test, right? So the in sample, out sample back testing will basically meant to make sure that this is not uh, data data mining, right? So we tend to do at least 50, if not 100 back tests to make sure we cover all angles. We're not doing a lot of data mining along the way. Yeah, so this one is to make sure that, hey, the strategy, whether after you've done extensive back testing, it still give you positive performance. Yeah, we are ready to use this strategy. But of course, for normal investors, you don't have to be so extensive, but generally speaking, when you look at something like that, when your platform is able to run or generate a backtest, um, When you see something like that, you can consistently beat the benchmark. I think you're good to go. Yeah, and not forgetting, you can actually run backtests or perform backtests in Excel spreadsheet. Right? It's actually not that difficult. Yeah. But of course, having a platform or any kind of um, systems is better than doing it on Excel, right? So these are the names that we have passed through the last during the last rebalancing in on the 30th of June. Of course, the next rebalancing date will be 31st of December, but depending whether it's a working day or not. Right? So the end of December, we rebalance this strategy again and determine the names to keep and the names to exclude from our investment portfolio. And in this case, you can see some of these names are actually what we find in the momentum models like your Tianxin, like your Del Monte. Del Monte, it's one of the F&B. I'm sure we are familiar with Del Monte. We eat a lot of their their canned pineapples or their
Yeah.
peaches. Yeah, correct. So these are household names that are experiencing a revival recently, right? So the model identified these names and included them in the investment portfolio. And some of the household names like Sheng Siong Supermarket, Venture Corp is one of the very key names within our tech sector as well. So these are some of the names uh, usually very familiar to most investors. Only some names that are more obscure would be like the Straits Trading, Straits Trading, and perhaps um, names like your Hobby Land, right? So this is a property developer um, that built very high-end properties. If you're familiar with Sentosa Cove, right? So Hobby Land is the developer behind some of these projects over there, right? So
Right.
yeah, it's not it's not usually in your household names that we talk about or covered by a lot of analysts. Yeah. So the good thing about having a process is to make sure that you're not just very reliant on, let's say, external or third-party analysts to contribute to ideas, but um, able to generate your own ideas and invest accordingly. Yeah. Of course, in this list, you will see quite a fair bit of REITs as well. So this color coded the REITs over here. I see one, two, five REITs within this portfolio, right? So um, in fact, most of them are doing fairly well, right? They're not big movers most of the time, but they usually served as the backbone for a lot of investors. Yeah. So yeah, in a nutshell, I would say this is a good way for investors to generate ideas and serve as a springboard for them to be more sophisticated in making sure that they're doing whatever is the best for them and not just um, you know buying ideas from others which may not be in their best interest. Yeah. So with this, I would also like to point out to investors that if in the event that you do not want to do stock picking for REITs because we have about 40 REITs in the Singapore market, you can also have an alternative shortcut in that sense by uh, buying one of these REITs or allocating to one of these REITs because it gives you exposure to the REITs segment in Singapore market without having to buy up the individual names. So the first name that uh, is in this list is the Lion Philippe S REIT ETF, right? So this REIT was incepted about 5 years, close to 5 years ago, October 2017. Um, its expense ratio, it's quite standard amongst the REITs in Singapore at 0.6%. Not very high nor very low, right? So the returns is quite similar to the benchmark. So the tracking error is relatively low. and 3-year Sharp is quite expected at 0.6. So that's what the index or the REITs market is giving you, around 0.6%, 0.6 Sharp, and the dividend yield is quite attractive at 4.4%. Right, so it's definitely something to consider. Yeah, if you don't want to do stock picking. Right? In fact, sometimes you can just incorporate this into your portfolio that you intend to build. Right? Let's say you want to build a portfolio of 10 names and have exposure to REITs as well. What you do is you just get a REIT ETF to manage it. It's easier for everyone. Right? The second one would be Philip SGX APAC Dividend Leaders. This one is not so Singapore centric. It invests in the region, but of course you can see the performance. It's lagging behind the Singapore REITs. Yeah, in fact, this is what we observe, that the regional REITs are somehow facing a lot of headwinds in terms of their, their performance. I believe it could be not just because of COVID, right? The actual reason I'm not sure, because we're still in the midst of researching on that, right? But this is what we observed. The APAC REITs segment tends to underperform SIM segment, and the Sharp is naturally lower as well. So when we put the two side by side, it's definitely not such a attractive proposition. And the indicative yield is also very low at 1.43%. Perhaps that may change, I'm not sure, but I believe they are decreasing their dividend payout. Yeah. But of course, this gives you a different exposure, because it puts 51% of its money in Australia, right, and a lesser part of it to Singapore. So for anyone who wants to have Australian exposure, this is something what you can consider, right, if you want to move away from Singapore and engineer a bit of exposure out of Singapore. Yeah. So, oops. And of course, the last one is the Nikko AM Straight Trading Asia ex Japan, such a long name, REIT ETF. Uh, this one also was incepted in March 2017. Um, Expense ratio very, very similar. The 3-year annualized return, if you see between the two, it's the least attractive, right? So, and that is also translated into the 3-year Sharp as well. However, its indicative yield is relatively high, right, at 4.5%. So this is something, perhaps if you want a fair bit of in between, uh, you can consider this, because it has 75% exposure to Singapore and the rest of it to the rest of Asia. And of course, the good news is there are two more upcoming REITs in Singapore. Some people say, yeah, why have more REITs? I would say it just provides a convenient way of investing in the REITs segment. Instead of doing stock picking, instead of managing yourself, you can actually allocate just one of the REITs that you choose, right? So the CSOP, or the CSOP IHS REIT Leaders Index ETF, is actually a joint venture between CSOP and SGX, because SGX actually created an indexing unit to meet the the increasing demand for indexation in the region. So IH is a brand created by SGX, and they have jointly created an S-REIT, or rather, SGX has developed a S-REIT Leaders Index, and CSOP is collaborating with them using the index to create an ETF out of it. And the next one to come up with uh, And a new REIT ETF would be the UOB. UOB is coming out with APAC Green REIT Index ETF. They have just officially launched the index last month, somewhere I think in October. Yeah, correct. So the actual listing of the ETFs is still to be confirmed. They're still working things out. So all in all, we will have about 5 ETF in the future for investors wanting to invest in both the Singapore-centric ETF or the APAC-centric ETF as well. So with this, I think I've come to the end of my presentation. And before I end this, I think I would just like to make sure I give everyone a key takeaway for tonight's session would be focus on process and the discipline and the diversification and the risk management and the reveal part of the whole process, or whether you're managing a trading portfolio or investment portfolio. Because by having a process, you can repeat what you do and never be random in trading or investing. By making sure that you have the discipline to see through your strategy and give it enough time to validate and benefit from its performance along the way, I think it's one of the key things that's missing in a lot of retail investors, because you tend to switch from doing this and that. You don't really have a very solid discipline in making sure that you stick with a process, right? A lot of people have processes, I believe, right? But the discipline to sticking with one long enough, I think that's quite lacking. And of course, having a proper diversification way of creating a portfolio is also lacking in a lot of retail portfolios. So strongly highlight to the audience that please make sure that you're diversified enough, right? Not having a lot of names within the same sector or within the same segment, right? Try to diversify as much as you can. And risk management is something that I can never stop reminding everyone, because you need to have a concrete risk management plan, because you don't want to fall in love with stocks, right? You don't want a failure of a single name within your portfolio to drag down your whole year's performance, right? Some of the examples I think recently would be your China Evergrande. Wirecard happened a few years back, right? So you potentially can see a stock going from 10 to 0, right? And that's the last thing you ever want to have these names in your portfolio, right? So risk management is very crucial for both traders and investors. And of course, the last part of it is always review and learn from your mistakes. Yeah, there is no, I would say there's no investors out there or even traders out there who say, I'm the finished product, right? Most of these guys are always telling their friends, I'm always learning, I'm always learning from my mistakes and readapting myself to the environment that could change, right? In fact, I personally know a very good professional trader who is struggling to adapt to the new market environment. Yeah, so he's going through a hard time, and we go through a lot of psychological problem that comes along with it. Yeah. So I hope everyone have a good process and a good discipline to carry yourself into the future, whether you're trading or investing for yourself. So I'd like to share a quote before I stop. So successful investing or trading, I believe, takes time and discipline. Sorry, takes time, discipline, and patience. No matter how great the talent or effort, it just takes time. And you can't produce a baby in a month by getting 9 women pregnant. Right? I believe this quote is from Warren Buffett. Yes, correct. So be patient, right? Don't rush into things. The more often we find ourselves rushing into something that we are not prepared to, we will find ourselves landing into trouble more often than not.
Right.
So yeah. So be patient. Don't rush. Right. Okay.
All right. Awesome.
Back to you, Benny.
Well, thank you, Jake, for not only just sharing us the opportunities that you can take in the Singapore market, but also giving an advice for investors and also traders on having processes when you make investment decisions, right? And also portfolio management.
That's right.
So yeah, thank you so much for the tips, Jake. And maybe Jake, you want to point out to your first page where you have the contact, if anyone wants to contact you. so that they're able to reach you out. And like you said, so the office number will be redirected to you, right?
Yeah, that's right.
Okay.
That's right. Yeah.
All right. So yeah, it's really 1.5 hours. Thank you so much. I'm sure your throat is really quite dry right now, talking for 1.5 hours.
A little
Well,
bit.
it's a real pleasure to have you here, Jake. Hope to see you again in our next session, right? And
Thanks, Benny.
thank you, everyone. Yeah, sorry. Thank you, everyone, for joining us as well. I hope that today's session will be beneficial for you guys to know more about the Singapore market. And we'll see you in the next webinar. Thank you, and have a good evening.
Thank you, everyone. Good night.